offering rest and rejuvenation retreats with daily classes in yoga, tai chi, meditation, the arts, and more. June through October. More information at eomega.org/rest.
Marketplace Morning Report is coming up next, and then in 10 minutes at 9 o'clock, it's the BBC NewsHour on WNYC. Let's check in with London to see what they're working on. London, good morning.
Good morning, WNYC. I'm Rebecca Kesby. On today's NewsHour, more Russian attacks on Ukrainian grain exports in Black Sea ports. We've got an eyewitness who watched the US soldier run into North Korea, and the new Barbie, an ironic feminist icon or the same old sexist stereotype. That's BBC NewsHour coming up at 9 on WNYC.
Mid-70s right now with sunshine, mostly sunny today and a high of 86. Then tomorrow, showers and thunderstorms. We'll need to look out for heavy rainfall producing some flash flooding across the tri-state. Mostly cloudy on Friday and just 81 for a high. 77 and sunny now at 8:52.
Netflix subscriptions are up. Netflix stock is not.
Marketplace Morning Report is supported by Palo Alto Networks. Palo Alto Networks delivers what's next in cybersecurity innovation to protect today's digital way of life. Learn more at paloaltonetworks.com.
And by Indeed, a streamlined hiring solution. Indeed helps businesses attract, interview, and hire candidates. Learn more at Indeed.com/hire.
From Marketplace, I'm Sabri Benishore in for David Brancaccio. There was a time, not long ago, when all a streaming service had to do was get more subscribers and its stock price would soar. Not anymore. Exhibit A, Netflix shares. The company yesterday reported better than expected subscriber growth in the second quarter. But this morning, its stock is down about 6% in pre-market trading. Why would that be? Marketplace's Nova Safo explains.
Investors now want streaming platforms to show them the money, and Netflix yesterday fell short. Yes, it reported almost 3 times the number of new subscribers that analysts expected, nearly 6 million. A lot of that growth fueled by the company's password sharing crackdown. Quarterly profit was also up, but revenues fell short of projections, about $8 billion in the second quarter, which means adding subscribers is no longer leading to as much new income as in the past. Netflix's revenue growth came in at less than 3%, compared to more than 8.5% a year ago. On top of that, the company is facing the same uncertainty as other media giants, a double strike by actors and writers who are demanding changes in how they are compensated. I'm Nova Safo for Marketplace.
The Federal Emergency Management Agency's Disaster Relief Fund is running low and is probably going to run out or run into the red sometime next month. That's before the end of the current fiscal year. It is also smack in the middle of hurricane and wildfire season. That is not great, but it turns out it's not that unusual either. Congress can approve supplemental funding. But as FEMA Administrator Deanne Criswell testified recently, throw in climate change and you've got some real strain on FEMA's budget. Marketplace's Samantha Fields reports.
If FEMA's disaster relief fund runs out of money, it doesn't mean the agency won't be able to help if there's a big hurricane. Craig Fugate was FEMA administrator during the Obama administration, and he says the agency will make sure it has cash for that.
But it means a lot of other programs like the rebuilding, the mitigation programs will either cease or slow down until they get more funding.
It's rare for that to happen, but Ari Ranoni, a deputy director of disaster recovery at Haggerty Consulting, says when it does,
this can really have this downstream effect where, the states, the local communities affected by these events, it just further delays their ability to recover.
With climate change making disasters more frequent and extreme, Craig Fugate says he thinks the amount of funding FEMA gets is too low.
We built our disaster response system based upon the last 100 years worth of disasters and weather data. Going forward, I'm not sure our infrastructure that was built for the past is holding up.
Or he says that our approach to disaster response is either. I'm Samantha Fields for Marketplace.
All right, let's do the numbers. S&P futures are down 0.3%. NASDAQ futures down 0.8%. Dow futures up less than 0.1%, just 5 points. The yield on the 10-year Treasury is 3.816%.
Marketplace Morning Report is supported by Amazon Business. From small business to big enterprise and everything in between, Amazon Business helps simplify the supplies buying process. Amazon Business, your partner for smart business buying. And by C3 AI. C3 Generative AI provides ChatGPT enterprise search that is verifiable, secure, and accurate across all enterprise data. C3.ai. This is enterprise AI. And by the new Glassdoor app. Professionals can now join real anonymous conversations within their company, industry, and communities and get answers about careers on Glassdoor.
The country's biggest banks have reported second quarter results, and many of them flagged that they were bracing for higher credit losses coming out of commercial real estate. A lot of businesses don't need or want as much office space as they had before the pandemic. So how likely is it that this could trickle down into loan defaults and stress the financial system? Lisa Nee is a managing partner in real estate at Eisner Amper. She joins us. Thank you so much, Lisa.
Thank you so much for having me today.
We know that some companies are not renewing leases for office space. We know that sometimes here and there, they've broken their leases, just gotten out of them. We hear these anecdotes, but do we have a sense of how widespread this is? How bad is it? How bad will it be?
So sublet space across the country is up about 250 million square feet. The vacancy is definitely climbing in most markets, so none of the markets are immune. And we know that office loan credit is deteriorating.
$1.5 trillion in U.S. commercial real estate loans are coming due this year and next year, according to the Mortgage Bankers Association. If those loans cannot be repaid in full, what does that do to the financial system? Can the financial system handle that?
You know, we know when the loans are coming due, but we don't know when the leasing within those spaces is coming due. And so when you look at valuation of the loans that are coming due to see who's either going to take those out and who's going to say that that's still a good investment. We were speaking to a client in San Francisco, and it's figuring out who's going to take out those loans and become the market maker. And it might be a much smaller per square foot as a valuation, but the banks are no longer willing partners in purchasing this. So we are going to need to come in and get some more creative investors, different strategies of who's going to come in and basically fill the need for the capital that has to be put in to bail those office out of where they are. The regulators and the banks, they're going to require more capital to even bail people out.
Is this a situation where we're going to see strain on banks like what we saw with Silicon Valley Bank, Signature Bank, that kind of thing? Are we headed there?
So when you looked at what was happening with those banks, it was what the asset was on those balance sheets and the liabilities being greater than the assets. You still have dirt here. You still have an actual building. And it's just what the valuation and what somebody's willing to pay for the building. And what was interesting with a lot of this stuff is that what the loan to value ratios are. And so we learned a lot over the last years in real estate, and the loan to value ratios on most of these projects actually had a little bit of room in there so that if the balance sheet should still stay relatively strong. So if the values drop, there still is cushion there.
Lisa Nee is managing partner and national leader of the real estate practice at Eisner Amper. Lisa, thank you so much.
Thank you. It was a pleasure.
In New York, I'm Sabri Benishore with the Marketplace Morning Report. From APM, American Public Media.